you move like states for a game, and they're like, yeah, it's a big deal in Arizona. And I was like,
That's
okay.
so interesting.
Yeah, so I started playing it. I'm okay at it. Like,
I've never played it.
really, it's really, really fun.
I see it's similar to tennis. I mean,
It is. It's a lot slower. It's called the world's most dangerous game, and it's not that it's dangerous. It's just that people take themselves out of their comfort zone too fast because they look at it and they're like, that's easy. That's not as hard as tennis. I can do that. But someone who's basically sat in a chair for their whole life is going to get out there and start trying to like juke and like.
Yep.
Then they had a so like torn ACLs and meniscuses are like very, very happens often with pickleball.
that's
And it's not pickleball's fault. It's the person's fault for jumping in, not being ready.
yeah. Where I was working out, it's like half of it is like a basketball court, and then they have like the giant like net thing on the other side is pickleball, completely full.
Yep.
And there's like four or five courts.
So just tick.
People were like waiting in line too.
Yep.
They get into it.
Yeah.
Yeah, I don't know.
Last time I was in Hawaii, we were right outside to the left of our balcony. There was the ocean right over here, but then back here you could like look around and there was a basketball court, and you could see the guys want to play basketball, but the pickleball people were like, no, and they just took over the entire pickleball court, and like the basketball guys were just like, eventually they'll leave, but no, they didn't.
No, they didn't
all
leave.
day long, whenever I opened up my thing, my blind, actually
reign
tick
supreme.
all day.
Dang.
Yeah.
Dang. Yeah.
All right, you ready to get into it?
I'm ready to get into it. I'm curious of where I'm going to start that one. I'm really curious.
I don't know.
I don't know.
We'll find.
Should I start at the very beginning? Because that was like 8 minutes of chatting.
We'll find a place.
We'll figure it out.
Well, guys, welcome to the pod. We are the Five Guys, as you can tell by our brand new cool mugs.
Whoop, whoop.
Whoop whoop.
They might be blending into the green screen. Just FYI.
We're not on a green screen. We're in a real. This is a room.
If they're shiny, yeah, we got the metallic like dark green. You know what? Don't worry about it. Don't worry about it. Don't even worry about it. We got an epic pod today.
We do. We have a big pod today.
Very big.
It's actually the second two-parter we've ever done.
Yeah.
So welcome, guys, to episode 2 of our two-parter on investing made simple, where today we will delve into crucial aspects of investing, including the 5 guys rules of investing, understanding different stages of investing during your lifetime, the 5 guys investment strategies, including ETFs. And we're going to finish up afterward, tell you basically how to invest. Well, why do I even need a financial advisor?
Yeah, you might not need Chris.
Yeah, you might not need me.
Or you might
want me. I don't know. So we'll talk about that too, and saying, was an advisor actually necessary for you and your own situation?
Bingo.
So after that, I say we dive right into it. How about we get into the 5 rules of investing by the 5 guys?
That's a great place to start.
Yeah, let's do it.
That's the best place to start.
So we have 5 rules here that Dom and I have come up with. Do you want to start off with number 1?
I love it.
Right,
Rule number 1, starting off at the beginning, making it simple as possible. Understand that the market always goes up, but in the long term.
Yep, like we talked about last time in last pod. If you ask me what's the market going to do tomorrow, I have no idea.
Yeah.
You want what it's going to do next week? I have no idea. Next month? No idea. Next year? 50-50 chance? I don't know.
100 years?
100 years? I'm going to assume it's probably going to be up.
With a high degree of certainty.
High degree of certainty it's going to be up.
Or, maybe not 100, because I'm not going to live to, I might live to another 100. But like next 50 years.
Yeah.
We know it's going to be up.
Given that we don't blow ourselves up,
yes,
I can assume that we will be in a better place than we were. And I know that every generation says this generation is the worst one, and after this it's going to go down. But people have been saying this for all of history.
Yeah.
Like we talked about, I think it was on last Friday, we talked about if we could go back in a time capsule to 1999 and tell people all of the bad things that were going to happen over the next 20 years, would anyone want to invest? And everyone would say, I wouldn't want to invest. I don't want to go through Y2K, through the housing bubble, through 9/11, through Iraq war, through COVID.
Yeah.
I wouldn't invest. But had you invested, you would have actually annualized 12% for 20 years, which by historical standards is crazy, even through all that volatility and uncertainty.
Gosh, isn't that the truth?
It is.
Rule number 2.
Rule number 2, acknowledge that the market corrections are inevitable and unpredictable. So by that, what we mean is no one can time the market. I know it's very easy for people to say, oh, well, investing is really easy. All you do is buy low and sell high. Well, that's easy to do when you're looking at a chart.
It's like saying flying a plane is easy. You just go straight.
Yeah.
Don't hit anything. It's like, it can't be done. It takes a lot of training.
Yeah, if you have a fancy time machine, then you can tell me exactly what to do and when to do it, but no one has that time machine and no one knows. You can always do your best and try to do it with a reasonable degree of certainty, but even when you invest that way, you're still looking at it in the long term. You can't say, oh, I buy this investment right now. Tomorrow it'll be up with 100% certainty. Again, that's when you're looking at technical investing, and I like to kind of equate that to looking at the clouds and saying like this means something.
So we talked about rule number one, market always goes up. Rule number two, the market corrects. It
They're
goes
inevitable,
up.
they're unpredictable. Yep.
You know, we talked about number three.
We haven't talked about number 3.
We haven't talked about?
No.
Nobody can consistently time the market.
Oh, I guess I combined them into two.
Kind of combine. That's why I want to do a little recap of the first
you.
three. Rule number four. Rule number four, once you grasp the basics of investing, paying less attention can be beneficial.
I think that's super true.
What were you saying earlier before the pod started about the best investors are the ones who forgot their password?
Yeah. So Fidelity, they released a study as to like their best investors. So the average investor through Fidelity who was actually going in there and trading their own accounts, they had an annual return of 2%. But then they also released who was their best investors, given a large, wide enough sample. And those people were actually people who, number one, forgot that they had a Fidelity account. And number two, were dead and no one checked the account.
Yeah.
So people that never looked at it again, just forgot they had it, whatever their accounts were sitting in, whatever was invested in, if they just didn't touch it and they just let it keep on winning, they were doing better than the people that were actively watching it every day, reacting to the news and trying to, quote unquote, time the market.
I love that. I hope that there's like someone out there that there's just an account that's been around for like 100 years or something, or a while. It's just building and building and building. I love that. That's so interesting.
I mean, that's what happened to me after when I first started investing. I had no idea what I was doing, and I just
died.
No, I died. Yeah, I died for a while.
I was back in 2004. I was out of here. Came back 2005. It was a good time.
No, I mean when I started investing, when I started my job, they were like, "Oh, you have a 401k," and luckily they did automatic enrollment. And someone at some point told me 10% is what you need to do, and I just believed it as law. Yeah. So I did that, and I didn't even know my password. I didn't even know how to get into the account. I didn't know anything. Yeah. I remember at the beginning, I like selected something, and it was probably a target date fund. And then after years and years, I left that job, went to another job, and then eventually I started learning about finance, and I was like, hey, whatever happened to that old account? So I went back, and I had to find it. Yeah. And then I looked inside there, and I only contributed maybe like, I don't know, $10,000 or something like that over the course of a few years. But then over the next 5 years, that $10,000 had grown to like $50,000. And I was like, I didn't even know this was here.
I'm $50,000 richer. This is great.
Yeah, let's go spend some money. Look,
the Audi dealership we go.
Free money.
Free money.
And then our final rule for number 5 is avoid panicking when the market experiences significant downturns, or another word for downturns is volatility. Volatility can go up or down, but don't freak out. Remember, we're sticking to the course. These market corrections are inevitable and unpredictable, but on the long term, over the next 100 years, we have with the most reasonable certainty, the market will go up.
Yep.
And remember what we talked about last time with the magic penny idea.
Yep. Doubling every day,
but you need that time in the market for that to continue to compound. Just like with that magic penny, on day 1 you have a penny, and that sucks if you could have gotten $3 million. But on day 27 you have $671,000. Yeah. It's not till day 28, 29, and day 30 that magic compounding really happens, and on day 30 you have $5.4 million. That's the power of compound interest. That's the power of having a long-term perspective. Yeah. So, number 1, understand that market always goes up. Number 2, acknowledge that market corrections are inevitable and unpredictable. 3, realize that no one can consistently time the market. 4, once you grasp the basics of investing, paying less attention can actually be beneficial. This kind of comes back to like, stop watching the news. Like, just don't freak out when every other people are freaking out. If you can be the calm in the storm, that's what people flock to, and that's what's going to make you successful. And then number 5, avoid panicking when the market does experience those significant downturns. When everyone else is freaking out and you're just sitting there chilling, like, you guys do you, I'm good. Shoot. The way that I look at it, when the market's down, that's a buying opportunity.
Absolutely. Everything's on sale. We love a good sale.
I think that investing is probably one of the few places. So a lot of our audience, they like Target. My wife loves Target.
I knew you were going to talk about Target. I had a feeling. I just knew.
So if you drove by Target and they had a big sign saying 50% off everything, I guarantee you it would be a madhouse in there. Everyone would be running in, grabbing whatever they can, trying to get to the checkout lines. But the stock market is the only thing that when we have a 50% sale, everyone runs the opposite direction.
Yeah,
They try to get the heck
panic.
out. Yeah,
Yeah.
they panic and they try to get out.
Yeah.
When that's the perfect buying opportunity.
It's true.
That's like seeing your favorite Le Creuset set on 50% off.
Yeah.
Time to grab it.
I don't know what that is.
It's a pot.
Oh,
My wife
cool.
likes them.
Cool. Yeah, I'm just a crock pot guy. I don't know about that fancy stuff. Dude, I cooked a crock pot meal last night.
Mm-hmm.
It was good, but I put too much sauce. So I went from we're gonna make this chicken marinara sandwiches.
Mm-hmm.
And I put too much sauce, so we ended up having tortilla chicken soup.
Okay, that's still fine.
It was really good.
I really need to get better at the crock pot. My wife always says, like, Chris, why don't you just make stuff in the crock pot? And
Dude, it's for you.
maybe you should teach me.
I'll teach you. Yeah. I'll teach you.
It scares me. I know my air fryer, and I'm good at air fryer, and it's just like investing, right? Like I'm good at this thing, I'm gonna stick with it.
Yep.
But I know once I branch out, it's not as scary as it is in my mind. I know that. I just have to do it.
Fear is a mile wide and an inch deep.
Fear is a mile wide and an inch deep. I like it.
Yeah. Crock pots. I love them. I love them. Alrighty.
On to the next point. I say we talk about stages of investing in one's life.
I love it. I love it. We got a lot to talk about. Ooh, I'm so excited for this podcast. I love this one.
Yeah, so first, there's multiple stages in life, but what we've done is broken down really into two big phases. What I used to tell my clients when I was doing estate planning is there's the wealth, there's the growth phase, there's the distribution phase, and then there is the preservation, then there's a distribution, like after you die. But after you die, we're not going to talk about that. We're going to focus on the growth and then the distribution.
Exactly.
Preservation, keeping your money,
And there's times to be more aggressive and times to be more conservative.
Yep. So let's first talk about when we're talking about the wealth building stage. So this is always going to be based off someone's age and then, of course, their life situation. Your age doesn't dictate all things.
No, because if you were a millionaire by 21, it'd be a little bit different than if you were just starting out and you're just a regular person.
Yep, 100%. So in the first stage, when you are in the wealth growth phase, we are trying to look to be a little bit more aggressive. And when I say aggressive, we're actually looking to buy equities. You know what equities are, Dom?
Talk to me.
Come on, tell me what equities are.
Equities, it's okay, don't get confused, guys. Equities and equity are the same thing. You guys have all watched Shark Tank or seen the clips. I'll take 1% equity in this company for 100,000, whatever. It's the same. It's similar. It's the same word. Equity.
It is. But the equities would be I want to have equity in your company and your company and your company and your company.
Equity and equities is just the plural version of equity. So basically, when you're buying a stock, that's an equity. So you're buying a portion or an equity of the. I'm trying not to use the word to define the word. It's kind of cheating.
You're purchasing ownership stake.
Yes,
that's the best
in
way
the company. Perfect. And it's not. If I buy Apple today, I don't get 50% of the company. It's a very tiny little sliver.
It is the tiniest sliver. But let's take a look at it this way. If you guys are watching us on YouTube, then you can see this. If you're on just the pod, right now I'm holding up our Five Guys cup. So say that this cup is a company and it is producing mad cash flow for whatever reason. Dom and I could both say, let's go in 50-50 and buy this company. We both have 50% stake in the Five Guys mug, meaning that we both own 50% equity of this company. Now, say this company continues to do well, and we decide, hey, we should open this cup up to let other people invest in it. And we open it up to 2 other viewers, and they buy in. Now we each have 25% equity in the cup company.
Yeah.
And now think of that for something like Apple or Microsoft. When you buy a single stock, you're buying a tiny, tiny, tiny sliver of that overall company. But as the company appreciates, as it brings in more money, who do they give that money to? They give it to their owners, who would be you in that situation because you own a sliver of that company.
Pretty cool.
I think it's super cool. The way I look at it is whenever I invest in a company, I am becoming an owner of that company.
Yeah.
Now, obviously, that doesn't mean I can call into the investor calls and be like, hello, Chris Monzon, minority owner. Let me talk to the CEO.
I don't like the way these iPhones are being made, man. Where's the innovation?
Yeah, get me Steve Jobs.
Yeah. Sir, Steve Jobs has been dead for 10 years.
Dig him up. I need to talk to him.
Dig him up. He's probably rolling in his grave anyways. R.I.P. Steve Jobs.
Yeah, R.I.P. But that is what equities are, is ownership stake in a company or ownership interest in a company. Now, that's for the wealth, for the growth side, when we're trying to grow our money as much as we can. Let's talk about when we're trying to preserve our capital. So what that would mean is someone has reached basically financial independence. and now they don't want to, or retirement, and they don't want to take on the undue risk anymore.
It could be financial independence too, though, couldn't it?
It could be, but typically with financial independence, we'll talk about this more. We're trying to actually have enough wealth that we can still keep it invested in equities and have so much money that even if the market continues to go up and down, we're still good.
Gotcha. So for financial freedom in simple terms, basically have enough in the market to where I can pull a little bit out and still live my life and be comfortable, so I don't have to do my 9 to 5, but it's still invested and still growing.
Yep, and even if it's going up and down, on the long term, it's going up enough. That's why we shoot for that 25 times the 4% rule of the Trinity study.
Perfect.
That still allows you to keep it invested in the market. But that's when we have to start talking about money psychology. That's when things get a little bit more dicey, because now that someone is no longer producing income through working, that's when starting to pull that money gets a lot more scary, and now they can't stomach the volatility.
I see. Yeah, because they don't want to have to go back.
No, they don't want to go back.
They don't want to go back.
Yeah, and that's when we're mirroring the planning with purpose and making sure that we're focusing on the money psychology, the money mindset, as I like to call it, along with the financial planning and the investing portion. Because people are people.
Yeah.
You know, you can't tell them like, oh yeah, invest all your money, and then tomorrow it goes to zero, and be like, no, it's okay, do it again.
Yeah.
Yeah. There are actually studies that show that if people use triple leveraged funds, meaning that you invest on a triple leverage, so every time it goes up, you get ×3, but every time it goes down, you go down ×3, you will actually outperform people that just do what we're about to suggest doing. But from a money mindset standpoint, within at least 4 times of your investing lifestyle, you will go down to zero and have nothing. And there is no way in heck that I can ever tell a client, don't worry, you went to zero, but let's do it again.
Is that why they say don't hold leveraged accounts?
The reason they say don't hold leveraged accounts is because the net asset value of when they close, they actually go down faster than they go up. So in the long term, it's the way the accounting works out on those.
That is deep. That is, yeah.
Yep,
That's pretty deep.
That's pretty deep.
We don't need to get into leveraged accounts.
So for a wealth preservation stage, if you're in that stage right now and we don't have the 25 times our annual expenses, what I would consider doing is shifting more to bonds and reducing your risk, so moving away from equities. But of course, in all portfolios, we never recommend any one thing. There is no one investment that you should be 100% in. You always need to have that diversification. But bonds are really good. And what bonds are just debt securities. They represent a form of borrowing from either a government, a corporation, or an organization. And of course, the biggest one would be the government, saying, hey, government, if I lend you $100, you're going to give me, or at this time, interest rates are like 5%, you're going to give me $105 back in 6 months, a year, whatever the duration is.
Yeah.
But then there's other companies. So say if you wanted to loan to Microsoft. Microsoft is very, very highly coveted, and they won't default on their debt, but they're not as highly coveted as a government bond, because the government actually has the ability just to print more money. So there's no way they could ever default, because they just print more money and give it to you.
Interesting.
And then the final thing for wealth preservation stage is maybe look at income producing investments and assets like alternative investments. If that's something you guys are interested in, put it in the comments. We can always talk about it more, but we are getting outside. But what we're going to be talking about today for the 5 Guys Common Sense investment strategies is going to be geared towards people in the wealth growth phase, when they're trying to grow their wealth as much as they can, because on that I can give more of a blanket statement than I can for people in the wealth preservation stage. Those need to be more cared for and individualized.
Yeah, absolutely. And we're going to be talking about index funds, what it is, where they hold them. Who was this index funds guy? What is this? Tell me more about index funds.
Yeah, so index funds are ways to match market performance.
Okay.
So it's how you get the average performance out of the market. And I know when people say, like, I don't want to be average, I want to be way farther than average. I want to be the best.
Yeah.
But only in the market is the average like the best. When someone says the average, that is the best. That is really what you can get. Can you outperform in the market sometimes? Yeah, you can. But on a long enough time horizon, it starts to get dicey. There are some advisors and investors out there that can do it. But for the purpose of our discussion, for you to be able to find that person is going to be pretty slim to none.
Yeah. Indexes are a great way to just take kind of the stress off of picking individual stocks, because you're picking a bunch of them.
Yeah, they mirror specific financial markets and indices. Indices is just another fancy financial term for indexes.
Yeah.
So
Let's talk about the common ones.
let's talk about common ones that you guys might have heard but never really knew what this meant. So if you ever turn on Bloomberg News, Fox, CNN, any of those, you'll hear people saying, oh, the Dow Jones went up 3%. The NASDAQ is down 2%. The S&P is up 4%. And most people just go, oh, okay.
Cool.
Yep.
Number.
I see a green arrow, that's a good thing. I see a red arrow, that's a bad thing. And then they start to say, and then they start to like judge and say like, oh, my advisor isn't doing anything because Fox News told me that things are going bad, when they really have no idea what the heck's going on. So let's talk a little bit about that. First off, you want to talk about the S&P 500 and what that is?
So the S&P 500, the S and the P stands for something. It's just not just like, it's not a random letter. It stands for the Standard & Poor 500 Index, which is a widely followed index of the top 500, well, not top 500, but it has
500-ish.
500-ish of the largest publicly traded companies in the U.S. And each country has their own exchanges too. So just for...
Yeah, most of our audience is here in America. We're here in America. I do have some home bias. So yeah, Standard & Poor's is often considered the benchmark for overall United States health.
Yeah.
Remember, with the S&P 500, it is market cap weighted, and what that means is that the larger the company, the more it actually holds with inside of the S&P 500. So I was telling Dom before the podcast that actually only 5 companies make up 18% of the S&P 500. But that's a good thing. People might say, well, now it just seems like it's over-levered. But it's not, because when you're looking to invest, there's something called momentum investing, where you want to allow your winners to keep on winning. In investing, there's an old term that I like to use. You don't cut your flowers and water your weeds.
No, not at all. Not at all. And the other ones are the Dow Jones Industrial, DJI.
Yep, often referred to as the Dow. It's actually the oldest and most famous stock market index around, and it consists of 30 of the largest blue chip stocks. Blue chips are mega companies, and it's designed to actually represent a cross section of the U.S. economy. So it's showing different parts of the market, how they're doing within there.
Yeah, and what kind of companies are on there? Like McDonald's?
So on there it's going to have like Exxon's in there.
Exxon. I think Tesla's on there now.
No, Tesla's in the S&P 500.
They're in the S&P?
Yeah, Microsoft will be in there.
Okay.
You can actually look up exactly which 30 companies in there if you don't mind.
Yeah, no problem.
And while you're doing that, I will talk a little bit about the last one, which is the NASDAQ. And the NASDAQ is a composite of indexes, including a bunch of companies that trade on the NASDAQ stock exchange. They're mostly into high concentration. And at this time, because the thing that happens to be working in the market are technology companies, so the NASDAQ is known to be pretty much fully invested in technology companies. But since technology companies make up the largest amount of what's driving the market, that's where they are. So they have a lot more volatility than, say, the S&P 500 and the Dow Jones do.
So some companies that are on the Dow Jones they're like massive brands.
Oh, I said Microsoft.
You said Microsoft, Home Depot, McDonald's, Caterpillar, Salesforce, Boeing, Honeywell, Apple, stuff like that. Walmart, American Express, even Nike's on there. Goddamn.
Is Amazon on there?
Amazon should be on there. I don't see it, but I'm sure it is.
Okay.
Yeah. Very cool. Very cool.
And then there are many more indexes that track a wide range of topics. You can honestly get an index that follows agricultural equipment. Like you can get that index.
Yeah, it can get real specific.
It gets very, very specific.
Very specific.
The 3 that we gave you are just the big ones that you're going to hear people tossing them around. So that way, at least when someone says, "Oh, the S&P is doing this," you have a little bit of an inkling. There's like, "Oh, it's Standard & Poor's." That's 500 companies here in the United States.
Yeah.
Now you get to know what is actually going on.
Yeah, absolutely.
And then there's so many advantages to index funds that I like for when people invest in them. Number one, they offer a huge number of diversifications from only holding one fund. So I know a lot of people say, well, I don't want to be over-concentrated in one investment. And that's true. If you just hold Tesla, you are over-concentrated in one investment. Or if you just hold Amazon, or if you just hold Microsoft, you're over-concentrated. But when you hold an index, you're not just holding one company. You're holding 500 companies, 30 companies. If you're on the NASDAQ, like 18 companies. So now we don't have to worry about, I'm not diversified, because you are diversified, but you only have to hold one thing. And again, simplicity is what I'm going for here.
Yeah, absolutely. And some of the benefits, like you were saying, are taxes. We love to pay less in taxes.
Oh, yeah.
We don't like paying taxes.
I don't like paying taxes.
I don't like paying taxes. I gotta buy snacks. I gotta buy snacks. How
am I gonna buy my cobbler?
I gotta buy the cobbler for the crock pot to show Chris how to do a cobbler crock pot. Yeah. We don't like to pay taxes.
Yeah. And another thing that I like about index funds is they have lower fees.
That's nice.
Yeah, and it's about controlling what you control, right? I can't control what the market's going to do.
No.
I can't control a lot of things in my life, but what I can control is how much I'm paying in taxes for the most part. And we'll talk about that more in coming episodes. And I can also control, for the most part, how much I'm paying to have my money invested.
Yeah, absolutely. Anything else you want to talk about for the index funds?
No, I think it's just important to remember that when we buy these index funds, they're going to go up and down, but we need to make sure that we're staying committed to the course of long-term time horizons, and then understand that risk-reward fee structure is crucial for making an informed investment decision. If you're confused by it, you can always reach out to Chris at monzonwealth.com. I'd be happy to point you in the right direction if I'm not the right advisor for you.
Absolutely. So getting on to segment number 4, ETFs, very similar to what we talked about previously, but they're not the same.
Now, ETFs and index funds are often, people think they're the exact same thing. While they have many similarities, they are not exactly the same thing. So you can invest in an ETF, you can invest in an index, and I say we talk a little bit about what do we prefer as the FI guys, to invest in ETFs or invest in indexes, and I'll tell you why. And if you disagree with us and you say, I think the other way is better, you're not wrong. Yeah. They both work. It's really depending on whatever personal preference you have.
Exactly.
But both ETFs and index funds are passive investment vehicles designed to track the performance of underlying indexes. So they both do the same exact thing, just differently.
Yeah, there's nothing, if you go against what we're saying, that's fine. There's a million ways to win and one way to lose.
Yep.
You got to get in the market. The only way to lose, if you're wondering, is to not invest at all.
It's to not do anything.
Not do anything, yeah. So let's talk a little bit about, they're both passive investment vehicles, right?
They're both passive investment vehicles. I think first thing we should talk about maybe is about the structure. Yeah, and there's a bunch of different reasons or ways that ETFs and index funds are differing. I just say we talk about like the top 3 though, because I don't want to
because we could get deep.
We could have like 4 pods just on this.
Yeah.
But then again, our audience would be like, I'm done listening to these guys because we're not going anywhere. So ETFs are a type of investment fund that track stocks exchanges similar to individual stocks, but they can be bought and sold throughout the trading day or market day. So you can basically buy an ETF at 10 o'clock a.m. and then you can sell it at 2 p.m.
Yeah.
Where an index fund are also traditional or actual mutual funds where they can, or are like mutual funds where they can only be bought and sold at the end of the day.
Once it's closed.
Once the close, because they have to come to something called net asset value. They have to settle net asset value at the end of the day before they're able to close out. So
interesting.
This could honestly be an issue for some people. And this is the reason, this is one of the big reasons that I foreshadow prefer ETFs. Back in 2011 or 2001, I think you can all remember the Twin Tower incident where we saw the planes flying in. Well, advisors at that time, they knew at that moment that once that first plane hit, the stock market is going to go down. The moment that second plane hit, they were 100%, the stock market is going to plummet. So people that were in individual stocks, ETFs weren't really around then. They were able to sell all of their stock and miss that huge downturn. But people in mutual funds, they had to wait till the end of the day to sell. So they could have seen that plane fly in at 6 a.m. and press the sell button. But guess what? They're waiting and they're watching their account value dwindle and dwindle and dwindle until market close at 5.
And it went down significantly.
Yeah, it went down. I think it was like a 20%
didn't they close
drop.
they closed the stock market for like
so
a week.
Yeah, after that, that's when they started implementing their safeguards now in the market, so that if it goes down a certain amount, the market closes. And
when it say closes, it stops.
Yeah, you can't trade anything.
Nothing
it's
can
just
be
done.
traded. Yeah.
And the reason they do that is because
To protect.
remember, everything is run by fear and greed, and sometimes when fear becomes too much, everyone starts to get on it. So those trigger events where they stop the stock market is just to give people a chance to breathe, think about it, and then they'll restart. And I think they usually shut down for like 15 minutes. It's not a big time, but it's enough
really? It's
time.
only 15? Really?
And I think it depends on the trigger of how much it goes down.
Yeah, because it's not just like, oh, it went down throughout the day. It's like, no, it's a hard spike.
Yeah, it's a hard drop.
Yeah. Oh, that's interesting.
It was after 2000. There was what was it? It was like called like Black Monday or something like that, where all of a sudden there was an issue, like a computer issue that dropped the stock market like 30% out of nowhere, and like no one knew what was happening, and everyone freaked out. So then that's after they went ahead and they implemented a bunch of things to stop from things like that happening.
That's different from Black Tuesday, right?
What's Black Tuesday?
It was 1929 when the stock market crashed.
Oh, okay. Yeah, it's different.
Similar. Okay.
Yeah.
Anyway.
And then minimum investments. Another reason that I prefer ETFs is that ETFs typically have no to very low minimum investment requirements. And now with fractional shares, you can invest in like the S&P 500 with just $1.
Yeah. Because you don't need to own all of one share.
Nope,
like
you
say,
just own the ETF.
Yeah, it's like, so if the ETF is $100 and I only have $50, and it's not like, damn, I can't invest. It's like, no, you can still put your 50 in, but you just get half the share.
Yep.
Yeah.
Yeah, and that's something that's amazing. Where with index funds, often they do have minimum requirements. Fund investments could be anywhere from $100 to $100,000.
Yeah.
So I just kind of see with index funds, the barrier to entry is just a little bit higher than with an ETF. An ETF, you can get in there whenever you want. Obviously, I'm not telling you that you want to be in an ETF because you can sell, because obviously we have the long-term time frame.
Yeah. We like the flexibility, but we're still here for the long run.
I like creating optionality in my life.
Absolutely. And tax benefits.
And tax benefits. That's a nice thing for actually both structures of an ETF and an index fund. ETFs and index funds are tax efficient, but I think ETFs are more tax efficient due to their structure and what kind of creation and redemption shares, so they actually minimize your capital gains distributions to you. Index funds are also tax efficient, but just due to the way that the capital gains are distributed, they may have higher inflows and outflows, which gets passed on to the investor.
That's nice.
Yeah, so it really depends there, but I find that ETFs on the whole are more tax efficient than index funds, but they're both extremely tax efficient. So for that reason...
And to take advantage of the tax advantages, you just have to own it.
You have to own it. It has to be in a non-qualified account.
Okay.
Obviously, with an IRA, you're not going to get any of those tax benefits because it's already in a sheltered account. And if you want to know more about that, go back and listen to our different investment vehicles podcast. I think it was 6 or 7. But for those reasons and a myriad of other reasons that we're not going to go into today, that's the reason that I, for my firm, use a lot of ETFs. I use more than just ETFs, but for my personal funds, they're invested in ETFs. Yeah. But obviously, that is not recommendation. I don't know your specific situation. But that's what myself and Dominic invest in.
Yeah. We like options. We like flexibility. That's it. And we like to buy in specific markets, not just
specificity.
Yeah, I'm not even gonna try it. We had on our disclaimer. I had a flub up. Do you remember the word that it was?
Suitable and applicable, but you said applicable.
Yeah, I added too many B's in there. It was hilarious. Chris was on the floor. But anyway.
We got it right.
Yeah, I deleted it. Wiped the hard drive.
Yeah. So now you might be thinking, all right, Chris, you're a financial advisor, and now you just told us all the secrets of how to invest.
Yeah, we got the sauce now.
I just gave you the secret sauce. Well, why are there even advisors? What's the point of having an advisor?
It was nice knowing you.
Yeah, it was nice knowing you.
Fi Guy podcast.
It's a Fi Guy. And I'm done.
And he's done. Well, it was a good segment. No, you still have value.
I think I still add massive value, but I do think that there are different types of investment advisors. And that might be, I think that's really important to actually talk about.
Definitely.
So there are different types of advisors in the industry of financial advisors, and this is what gets very complex very fast, is basically anyone with a license call themselves a financial advisor. Even if their license doesn't give them the ability to manage money.
Interesting. So I could be a licensed financial advisor.
Well, you need to first go and get a license, but that license can be, there's different licenses. You can be a broker-dealer. A broker-dealer are someone that get paid commissions for selling investment products.
Oh, okay.
So you can go ahead and you can go get an insurance license where you can sell life insurance, you can sell annuities, and then you could call yourself a financial advisor, but you can't manage money. You don't have that license.
Interesting.
Now, there's some issues that happen there. As I'm sure you could imagine, audience, when you have someone that gets paid a commission to sell you a financial product, they might not always have your best interest at heart. Imagine this. You have investment option B, or investment option A, investment option B. Okay. Investment option A might be better for you as the end user, but investment option B gives me, the broker-dealer, a bigger commission for selling it. They both work for you, but investment option A is better. I'm sure you could see that everyone needs to eat at night. So most people, unfortunately, are going to go with investment option B and sell you that, even though it's not the best for you. It's not in your best interest.
That's shady.
It's not shady. I mean, it is what it is. But I'm just saying there are two different ways of doing things. But luckily, after 1990, we introduced something called fiduciaries into the world of financial advisors. And fiduciaries don't work off suitability standards, what is suitable for you. They work off of best interest. So there's different ways that fiduciaries can be paid. Number one is assets under management or fee only. So they're actually incentivized to grow your wealth because that's how they get paid. So if you lose money, they lose money. If you make money, they make more money.
Okay. Simple enough.
Yep. So you have alignment in growth. Alignment in that we both want to get you to the same place because both you and the advisor are aligned that they make more money, you make more money. Where with a broker-dealer, they made money on the front end. Whatever happens to you doesn't matter.
No. I think I like the second model where they get paid when you get paid.
Yeah, and also remember, this is something that a lot of people don't really think about, is even if the market goes down under a fee only, the advisor still gets paid, but the advisor is still adding value to you because a good advisor shouldn't just manage your money.
No.
They shouldn't just be investing, and that's the only reason you keep them. You should keep them because they focus on a lot of other things that they're adding to you from a consultative standpoint.
Definitely.
Yeah.
And the personal experience and tailoring.
Yeah, the tailoring of everything. Yeah.
Yeah.
That's the big reason that people pay me what they pay me. It's not just because I never promise, like I'll beat the market. I never focus on that. I focus on making sure that we have a good money mindset and that I'm there to tailor what we're talking about here in the podcast to your individual circumstance so that people don't have to listen to a podcast or how many podcasts have we done thus far and try to say, okay, based on all the things that they've talked about thus far, how can I apply this to my life?
Definitely.
You know, you get that when you work with me. And then the final one is an hourly consultant, which I also do as well. That's where you pay for a periodic review. They also work in your best interest. From my experience, I do assets under management. I also do hourly consulting. From what I found is when I do hourly consulting, people often don't actually take action on the planning that we do.
They kind of get a little bit complacent. They don't appreciate it.
No, I think they appreciate it, but I think it is without that ongoing check-ins. Because with my other clients, like we'll check in usually when someone onboards, we check in like once a month for the first 6 months, and then after that it becomes quarterly or annually.
Yeah.
But for when someone pays me, like it's only as often as they pay me, and that could for most people it's usually like once a year. And if I give you the best plan once a year, unfortunately, the next year when I meet with them and I'm like, hey, what happened? They're going to tell me like, oh, I didn't do any of that stuff. But what happened is I need to change the plan now. And I always tell them exactly what I say on the pod. You don't need to have the perfect plan to start, but you need to start to find the plan.
Yep.
So, yeah.
You got to execute the plan.
Yep.
Draw the plan, execute the plan, reap the rewards. If you don't execute it, and the plan was useless to begin with.
Yeah, like I talked about in this, you both are the general and the soldier. You know, together, if we were working together, we'd be the general together. We're coming up with a plan together, but you are the one that actually needs to implement it. And unfortunately, when someone pays for hourly consulting, they don't implement it. But when they're doing assets under management, or I'm actually managing it, I'm there with them, implementing it alongside them, if not for them entirely.
Yeah.
So just a little bit different ways of looking at things.
I love it. I love it.
So sure, if you guys are down the financial independence rabbit hole, some people might say that, well, why would I even pay advisor fees if the market, if the market works? And you're 100% right. If you can stick to it and never go in and out of the market, then most advisor fees aren't really worth it. But I can tell you from personal experience and my professional experience, while people might say, oh, I'll just stick in the market if it goes down 30%, they won't. They can't.
No. You got to have a real strong stomach for that.
You have a real strong stomach. Like Warren Buffett said, you don't know who's swimming naked till the tide goes out. And just like that, you don't know who you are till you're in that situation. I do Brazilian Jiu-Jitsu, so I'm a relatively good fighter. And there's so many people that say, oh, if I got in a fight, I would just see red and I would just mess them up and it'd be done. Yeah. And you can say that, and that sounds all well and good, but until you're actually in that situation, you don't know who you are. You might be the person that just goes, uh-oh, and runs away. Yeah. And I might be that person that just goes, uh-oh, and runs away. We don't really know, but we have to train ourselves and train our minds in order to get there. And this is something that's been very difficult over the last, really 20 years. Historically, we would have recessions every 3 to 5 years. This was back in the 1900s. 1990 to 1999. We'd have recessions every 2 to 3 years. Then eventually it went to every 5 to 7 years. Then after 2000, it went to every 10 years, and now we're even longer than that, 10 plus. So the issue is people will go into the market. Say you went into the market in 2009. You went into the bottom. Yeah. You basically had 11 years of nothing but straight up growth, where you thought, I'm the greatest investor in the world. Yeah. And then 2020 happened, and for the first time in people's long history of 11 years of investing, things went down 30%, and people lost their poop.
They lost their mind.
Yeah. People lost their minds. Yeah. And that, I'm telling you, an advisor keeping you in the market one time has made their fee exponentially. Yep. Just keeping you in the market one time. And there are some people out there that just have the confidence to feel that they can invest more, knowing that there is someone there watching it and being tactical. Because there are times where it is worth going in and out of the market, but you need to really know what you're doing. And for our audience, what we're trying to do, you're not there yet. You can be, but it's going to take a lot more time and dedication than just saying like, I'll know, because you won't know.
No, it's better to stay in for the long term. And the mindset that needs to be developed to weather not just a financial storm, but storms in general in life, it's very important to just build that calm. To understand that you're going to be okay.
Yeah.
Everything's okay.
Remember, a good advisor, they don't focus on just the return. Remember the coin example we did, where we were saying heads would be how much money you're making, tails is how much money you're spending, and then the outside of those heads and tails, the edge of it, is your investment knowledge. Unfortunately, most advisors only focus on the investment knowledge. They only focus on the edge of the coin. A good advisor should be focusing on the heads and the tails, and that's where they really add value to being able to work with clients.
So if I'm looking for an advisor, I should look to see if they're a fiduciary and like what aspect of the business, because you can be a fiduciary, but not in every aspect of the business, right?
Yeah, that's actually really insightful, Dom. Good knowing on that. So I always like to say there are 2 questions you can ask when you're working with a financial advisor. You feel good at it?
I feel good about that one. Yeah, I feel good about that. I'm gonna clip that. That's gonna be my new ringtone.
You're
Good job, Dom.
Dom, you're so smart.
You're smart. You're so loyal.
Good boy.
Maybe not the last one, but the 2 before.
Yeah, but I think it is important to make sure you're working with someone who has the best interest at heart. So the first question I would ask an advisor, if you're looking, if that is you and you say I probably do need somebody, and it doesn't mean that you're not smart. It doesn't mean that you can't learn these things. But if you're a doctor, if you're a dentist, if you're a mechanic, and that's your job and that's what you're focused on, do your job. Focus on that.
Absolutely.
If you want to go faster, you go with someone who's gone there before.
Definitely.
And that's where an advisor can really be instrumental, because no one can be perfect at all things. I've dedicated my life to this. I think about this literally all the time. I don't know why, but for some reason I like it. It's weird. So the first question I would ask somebody if you're looking to work with them as an advisor is, are you a fiduciary? And the answer should be a resounding yes. If they give you a well, let me tell you about this, you can still work with them, but just proceed with caution. That brings me to my next question. If they say yes, the next question should be a follow-up to that. Are you a fiduciary in every aspect of your business?
Definitely.
And the reason for that is something called dual registration, where someone can be both a fiduciary and be a licensed broker. And then they can kind of do it in different times, and you have to ask them, are you working this hat or not? What hat are you wearing? Are you wearing your fiduciary hat or are you wearing your broker-dealer hat?
Yeah, that's concerning.
It is concerning, but a good fiduciary, if you are a good fiduciary, and right now there are a bunch of rules going through Congress where they're trying to minimize what the fiduciary standard is, which I'm very much against. I think the fiduciary standard should probably be held to a higher standard, which makes it harder for me and my job. But I think it's important because while I know that I'm not going to do anything to wrong my clients, I still worry that there are people out there that would be. So I would like them to have higher standards. But it is what it is. We work within the realm of what we have.
Definitely.
But people can always change that hat. So I think it's important to always ask that question, are you a fiduciary in every aspect of your business? Because they can be a fiduciary for you when they're managing your money, like what investments they put you in, but they might be acting as a broker-dealer if they were to sell you life insurance.
Interesting. Interesting, yeah. Yeah, that is probably the most important question you can ask when looking for an advisor.
Yeah, and I'm not saying that broker-dealers don't add value.
No.
They definitely do, and there's a reason they're still around and they're doing great. For the first time, though, RIAs, registered investment advisory firms like myself and advisors, have actually surpassed the big broker houses.
Oh, cool.
So historically, it was always like Merrill Lynch, Morgan Stanley, all those companies. They've always had all the money because they have legacy value. Everyone just knows their name. But for the first time, actually, in 2023, RIAs, so fiduciaries, have actually surpassed them and actually have more money under management because people are starting to realize, like, oh, these people have my best interests at heart. Maybe I should work with them.
Yeah, that's good.
Kind of cool, huh?
That is very cool. In conclusion,
I think the most important thing, again, is just to remember that we have a long-term time perspective here. We're not investing for tomorrow. And instead of just focusing on the returns you get, focus on your money mindset. Focus on how much money you're making. Focus on how much money you're spending. You can't control what the market does. No one can control what the market does. But what you can control is how you react to things. And what you're doing in order to set yourself up for retirement every single day. And again, if you are making more than you spend, either way, you're going to be good.
Yeah, definitely. Do we have an assignment for this week?
We do have an assignment. It's a big one.
Okay, lay it on me. What do
If
we
you
got?
remember last week, we talked about your homework assignment was to go and open up a brokerage account or an IRA at one of the large custodians, whatever custodian you wanted. I said that I used Vanguard historically. They were my first one, but now I use Charles Schwab for my clients. Fidelity works, wherever you want to go. So hopefully you open that account. If you haven't, that's your first assignment. But the assignment for this week is I want you to invest any amount of money that you can into anything that you want to. You can invest it in a bond. You can invest it in an ETF. You can invest it in an index fund. You can invest it in your favorite coffee place. Whatever you want to do, invest it in something. The reason I want you to do this is now you can add the identity of I am an investor to your identity, and you can also see that this isn't as scary as you're making it out to be. So please think about this, guys. We have nothing to sell you right now when it comes to this. If you open an account at Vanguard, Fidelity, Schwab, they're not going to pay us anything. I might be a custodian at Schwab. They're not going to pay me anything for you opening an account. If you invest money, we have nothing to gain from it, but you have the world to gain.
Simple as that.
It can really set your life up in a perfect place. I just wish that someone had told me that. I think it was actually a YouTube video that I watched when I was younger that really kind of set me on the path of someone just telling me, turn off this YouTube channel, or as soon as the credits roll, go to Vanguard, go to Fidelity, go wherever you want. Go to Charles Schwab. You can even go into Google and say, where should I invest my money?
Yeah.
Whatever you want to do, do it. And if you need help, you can reach out to me at Mons on Wealth, but I'd be happy to send you in the right direction. But the first thing we need to do is you need to get started.
Definitely.
Too often do I hear, how much money do I need to invest? How much money do I need to have in order to start investing? Mm-hmm. There is no magic number. You just need to start.
Yep.
You start with $1. You can start with $5, $10, $100, whatever you want.
Simple as that.
Mm-hmm.
All righty. I think that's a doable lesson. Doable, actionable assignments that we need to start, guys.
Yeah.
You got to start. Just do it. Get it out of the way. See the job, do the job, avoid the misery.
And I can promise you that it will make a positive impact on your life. And maybe your goal isn't financial independence, but like I say, there is no one in this world that pursuing financial independence or just getting better at money doesn't help.
No.
It's like we talked about last Friday feedback. If someone walks into a gym and says, I'm going to squat 300 pounds, and they would just walk under the bar, they're probably going to get hurt. But if they decide, I'm going to stay committed to a path of working to be able to squat 300 pounds, even if they never reach that 300-pound threshold of squatting that much, mm-hmm. the entire journey has made not only their fitness life better, but also every other aspect of their life has become better just by doing some squats at home, to eventually getting underneath the bar, to eventually loading up one plate on each side, to 2 plates on each side,
yep.
and then voting that, what would be 25 on each side would be 290, 295?
You know I don't do the bar.
Yeah, it'd be okay, well.
Well, because, we talked.
Eventually you'll come with me and we'll start lifting together.
I love it.
But yeah, guys, like you never really know where this journey is going to take you. But I can promise you, by focusing on just getting better with your money mindset, mm-hmm. it will just pay dividends in so many different aspects of your life. You never know what those aspects are going to be until they come up. And hopefully one day, my dream is that you look back and say, thank you to Chris and Dom for setting me on this path, because I never knew what it would be until I started.
Definitely.
Yeah, and I can look back and I know that time. So please, smash that like button, hit subscribe. Please stick around for our next episode. Next Monday, we're going to be talking about everyone's favorite thing, tax optimization.
Woo!
Taxes! Let's go!
That's hype.
But it's really big for financial independence. It's not about how much you make. Well, I guess it is, but more importantly than what you make is what you keep.
Yeah, definitely.
Yeah.
Yeah, guys.
Remember the fee for the show? There is a fee. I'm not going to ask you for your credit card. I'm not going to ask you for your debit card. None of that stuff. But if you found any value, and I hope you did today, tell one friend about the Five Guys.
One person.
All right, guys. Later.
Peace.
This video podcast is sponsored by Mons on Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the hosts and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monsonwealth.com.